There's nothing funnier to me than retail investors' sentiment, changing. And I am fortunate enough to be in a position here on Twitter. I can really gauge investor sentiment in my own comments whenever I get likes and dislikes, and whenever I get, unfollowers and followers on Twitter and here on YouTube. And I actually wrote this tweet in February 2nd, and I said 20 unfollowers so far. It happened 3 times before. The first time it happened was in 2021 when I was shorting ARK Innovation. I was doing videos on this topic, and it was again pretty hated because they were calling Michael Burry the boomer, and then he doesn't know what he's talking about. Now the second one was actually on the June rally whenever we had the big summer rally, and the third one was actually on February 2nd. And this has actually successfully so far marked the top for 2023 on the S&P 500, which is again pretty funny to me how fast retail investor sentiment actually changes. And now I'm starting to get the same people that unfollowed me follow me back on Twitter, and it's just again this whole thing is pretty funny to me. And the stock market again is finally starting to go down. We talked about this many times before. We talked about it going back in the channel, and if it does go back in the channel, for me that would normally mean that the bear market is not over. That would normally mean that the worst is not behind us, and maybe we have a long way down to go on the S&P 500. And this is what I'm going to talk about in this video. I'm going to assess the situation with Silicon Valley Bank on why the S&P 500 is going down, and if we do continue going down, what is my actual plans for me to do in the stock market, because I'm still sitting on a pretty large cash position since pretty much November and December, and I also have some short positions I'm gonna talk about my whole strategy in general and what I'm planning to do as we go down. So again, I hope you enjoy this video. Now, to get started and talking about Silicon Valley Bank, the bank has officially collapsed. The largest bank since 2008, Silicon Valley was the 16th largest bank in the US, holding more than $210 billion in assets. And unfortunately, 95% of the Silicon Valley Bank's deposits were actually not FIDC insured, which is a lot of trouble to many companies such as Roku, which Roku actually had 26% of its cash position in Silicon Valley Bank, and they have no idea when they will actually be able to recover those deposits, which again is pretty bad for the bank. There's plenty of other regional banks that might be following along. This is maybe not a story that's going to just end tomorrow. I was thinking that it's a little bit more simpler than that in my previous video, but it's actually showing up to be much worse than we actually expected, and we don't know what's really going to happen next, which is why I'm not going to predict what's going to happen next, because no one knows. I'm going to talk about the S&P 500 and the whole valuation on it, and again try to determine what's happening with the S&P, because most of you that are watching me actually care more about the market than Silicon Valley Bank, because the economy is not the market, and those two are pretty different things. And looking at a chart of the S&P 500, which I try to post every month or two on Twitter, this is actually the inflation adjusted S&P 500 with a trend line that pretty much shows fair value. We did hit this trend line in 2001. We actually blew past the trend line in 2008, and this trend line is actually telling us that the real S&P 500's fair value adjusted to inflation is more around 2942, and now the S&P 500 is currently 34% above this inflation adjusted line, which again would show us that the S&P 500 is overvalued. But there's a lot of other metrics we can look at to determine the valuation of the S&P, and this is something that I've been talking about for a few weeks right now, and this is the 6-month T-bill yield, which is actually surpassing the yield of the S&P 500. Normally the S&P 500's earnings yield has to be much higher than a 6-month T-bill to compensate investors and to compensate you for actually holding the S&P, because it's riskier than actually holding T-bills. But now the S&P 500 and the T-bills are actually yielding the same yield, which is something pretty unusual, and it would show you all the FOMO on a lot of things that we have in the S&P 500. But looking at another pretty common metric we can look at to determine a fair value on the S&P 500 is actually earnings estimates, which are now 223. Now, I personally don't think they will end up at 223. I think they have ways down to go, and the bottom is more closer to 200 than 223. But again, using 223 and using a PE ratio of 16, which I believe is on the higher end with the current profit margins and with the current rate hikes, but taking again a 16 multiple, this is around 35.68 on the S&P 500, and I believe this is on the higher end. Now, taking the same 223 and using a 15 times earnings multiple, which I still believe both of those are nowhere close to a bargain, this is again 33.45 on the S&P. Now, if I am right on my 200 target on the S&P EPS estimate, and we do trade around 16 times earnings, this is more around 3,200, which I believe is the real type of bottoms that we will most likely have in the S&P 500, not just because of those levels actually showing that it's overpriced, but there's nothing else that's indicating a stock market bottom other than the technicals that were pretty bullish, and they are no longer bullish on the S&P 500. None of the fundamentals are indicating to me that the S&P 500 has bottomed. And even investor sentiment, which is very, very important. We can see what happened with the AI stocks, with C3.ai, with Nvidia, with Tesla, with all those stocks, and any stock related to AI has been going up like never before, and investors' euphoria was stronger than ever before. And again, this is not what normally happens at bottoms or at bear markets or even after a bear market. Normally, retail investors take years and years for them to get back in the market. They call the stock market a scam. They bail out on the market. They go look for real estate or bonds or whatever else they want to do, or S&P 500 index only. They don't pick individual names. But this is not what we have been seeing over the previous months, which would make me question that does it really just go away that quickly? Does this fear just goes away that fast and then the drama comes back? This is not normal. Stock market bottoms are somewhere pretty close to stock market bottoms, which leads me to believe that maybe the S&P 500 has a long way down to go, and we might actually be bottoming closer to 3,200, where we finally get, the flush. We bottom on actual true, pure, good fundamentals, and this would mean a more sustained rally, not like the rally that we, actually had. This is the most likely scenario. And in case of this scenario, as I talked about before, if we go below the channel, that would mean to me that the bear market is back, and that would mean to me that I have to get back to my own tactical positioning like I was doing in 2022. In 2022, every time we hit the trend line, I open a short position. When we go down, I cover the short position. It has been pretty much the easiest money I have ever made. Then I open a short position, and then I cover a short position. And this is what I'm trying to do right now, pretty much the same thing. Yesterday, when I did one of my videos, I bought June 16, $70 put on HYG, and my reasoning was that if this is really another GFC or a liquidity event, investors have to be selling those junk bonds because they want to get liquidity. They try to cut out the bad stuff first, so junk bonds have to sell off. So I went shorts on junk bonds just to protect my portfolio, and now they went up like 41% in just pretty much one day. I cut off some of the position today, and then I might cut back a little bit more on Monday or Tuesday, depending on what really happens. And this is the stuff I share on my group, but I also shared with you guys the 6 months put I had, the June put on the S&P 500, and now it's up more than 114%. Now, the main reason I'm sharing that stuff with you is not to show off or anything. I even share some of my losses with you guys on the channel. But the main reason I do that is to actually show you that I have skin in the game. I don't just talk about something to get views or to do whatever. I mean, 1,000 views, they don't pay much on YouTube. I'm trying to share my thesis on the S&P. And if I do say that the S&P is going down, I most likely either have a big cash position, which I do, but I also most likely have some, short positions to try to put my money where my mouth is. And I'm personally looking for many more short positions. Some stocks that I'm looking at are actually Moody's and the S&P Global. Moody's and S&P, again, they do the credit ratings on many of those, type of debt instruments. But whenever we have higher interest rates, we have less and less debt being issued because it's not as attractive as before. So these companies are actually suffering in terms of their business models. But those companies bottomed at 12 times earnings in 2008, and now Moody's is trading at 31 times earnings, and S&P Global is trading at 28 times earnings. Now, I don't care how high quality these companies are. Those multiples are extremely, extremely expensive for the kind of environments that we are in. I mean, let's assume rates go back to zero. What kind of multiple Moody's trade at? 50 or 60 times earnings? This is absolutely ridiculous for those companies. So those are some of the short opportunities I'm looking at. It doesn't mean that I'm going to do it, but this is some stuff that I'm actually, looking at, and I try to use this channel as my, cutoff or my, stops whenever I do that. So if we do go back, above the channel, this is when I cut my losses to try to limit my downside. If we start going down on the S&P 500, I normally let those positions run just in terms of a risk management strategy, but I'm also looking to deploy my cash position, which is fairly large. I have a watch list of many stocks that I would love to own over the long term, and actually one of those stocks is SPGI, S&P Global. I would love to buy the stock around the $200 range or $220. If it does get there, I'm going to buy it. But my main, goal and what I'm trying to do is, if this is really it, if this is what's going to take us to new lows, I'm going to use those stocks that I have on my watch list and slowly open positions in them, and then dollar cost average on the downside. So whenever we do hit a bottom, and no one knows when the bottom is going to be or what level is going to be, we can only guess. But because we don't know, it's best to actually buy those stocks at fair value. If they get more undervalued, you add a little bit more to them, and then once we do bottom, you actually have pretty big positions that are actually built at pretty amazing cost basis. And this is what I'm really trying to do as we go down. Maybe again, this is another fake out. Maybe we just go back above the channel and then we go and make new all-time high, 4,800, or maybe some people were calling for 6,000. Maybe this is it, maybe not. But again, I have a plan for everything. If we keep going down, I know exactly what to do. And if we keep going up, I also know exactly what to do. And I encourage you guys to actually have a plan for, a plan A and a plan B of what you're trying to do in the market in either of those scenarios. So thank you for watching this longer than normal video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.